Okay, let's kick things off. There's this figure floating around. US $49.8 billion dollars.
Right. That's the total PE and VC investment in the U.S. for 2023.
A huge amount, obviously. And here's the kicker, it's actually down. Like 11% down from the year before.
And even more significantly down from the peak in 2021, about 34% off that U.S. $75.9 billion number.
Exactly. So it really makes you stop and think, doesn't it? What does this dip actually mean for innovation, for, the next big ideas coming through?
It definitely raises questions about the whole ecosystem. We tend to think of entrepreneurship as that first vital spark, right? Someone sees a problem or a better way, and they have a vision, the creativity.
Yeah, the drive to actually build something new.
And as our source material from cognitive market research points out, that's where venture capital often steps in. It's the fuel for that spark.
Precisely. Entrepreneurship fundamentally is about spotting those gaps, those unmet needs, or just thinking, hey, we can do this better.
And then actually acting on it, taking the risk.
Right. It's about challenging how things are done, pushing boundaries. The article really nails that it's vision and creative problem solving, trying to fix things or improve them.
And what's interesting is how VC fits into that. It's not just money, though that's obviously huge for early stage companies that can't just walk into a bank.
True. Traditional funding is often off the table.
So VCs bring the cash, yes, but also strategic guidance. They recognize these high-potential startups need more than just dollars.
Yeah, it's like giving someone climbing gear and a guide who knows the mountain.
Exactly. The article mentions strategic advice, industry connections, mentorship, all that stuff that helps navigate those tricky early days.
So like helping them figure out if their product needs a tweak based on early feedback, maybe?
Precisely. Or advising on the best time to pivot strategy. It's that hands-on experience.
And when you put entrepreneurship and VC together, that's where the magic happens for the economy, right?
Absolutely. You get the groundbreaking ideas from the entrepreneurs.
And the resources and know-how to scale them up from the VCs.
And that combination, as the research shows, really drives economic growth. You get innovation, jobs are created, competition increases. It benefits everyone, ultimately. We see it all the time, especially in tech.
Okay, so let's dig a bit deeper then. What are the specific advantages VCs bring? You said it's more than money.
Definitely. First off, the money is a big deal. Significant sums, often without that immediate pressure to pay it back like a loan.
Which must be a huge relief for a startup.
It is. It lets them focus on product development, finding customers, building the foundations, not just scrambling to make loan payments when revenue is maybe just starting to trickle in. That kind of patient capital is vital.
It makes total sense. You can't think long term if you're constantly stressed about next month's bills. The article also mentions strategic knowledge. What does that actually look like day to day?
Well, think about it. VCs often have built businesses themselves, or they've seen dozens, maybe hundreds, go through the process. They've seen what works, what doesn't.
So they bring that pattern recognition.
Exactly. They can advise on market strategy, operations, management, help steer startups away from common mistakes. It's like having access to this collective wisdom.
Like avoiding reinventing the wheel on basic operational stuff.
Right. Maybe advising on how to structure the team for growth or the best way to approach a go-to-market plan. Really practical stuff.
And the networks. People always say it's who you know.
And it's often true in this world. VCs usually have these extensive networks. They know people.
Potential partners, customers.
Yeah, potential partners, key hires, maybe even the next round of investors.
Okay.
These connections can open doors that a startup just couldn't open on its own. Helps with collaborations, finding talent, getting noticed.
It almost feels like getting VC funding is a signal in itself, like instant credibility.
That's a really key point. The article mentions this too. Getting backing from a respected VC firm sends a message.
What kind of message?
That smart, experienced people have looked closely at this company, at the team, the idea, and they believe it has serious potential. It's validation.
Ah, okay. So that vote of confidence makes it easier to attract more investment later, maybe. Or even win over skeptical customers.
Definitely. It builds trust and signals high potential all around.
Okay, let's shift gears slightly. We've talked about getting started. What about growing, scaling up? Where does VC fit in there?
Scaling is often the make or break phase, and it takes serious resources. You need money to expand operations, enter new markets, maybe build factories, or hire huge teams.
So more money needed, basically.
A lot more, usually. And VC is often essential at this stage too, providing that significant financial muscle for rapid expansion. Think about launching nationally or internationally. That costs.
Right, so the financial role continues, just amplified,
Yeah.
but the strategic side must be just as important when things get bigger and more complex.
Oh, absolutely. Scaling brings a whole new set of challenges. Managing complex supply chains, larger teams, different regulations in new markets.
Things founders might not have experienced before.
Exactly.
Yeah.
VCs who've guided other companies through that scaling process bring invaluable experience. They help avoid the pitfalls of growing too fast or in the wrong direction. They might advise on how to enter a new country, for example.
And I guess the network becomes even more important when you're trying to break into, say, Europe or Asia.
For sure. Access to potential clients, partners, talent pools in those new markets is critical. And that VC credibility we talked about. It helps even more when you're trying to establish yourself on a bigger stage.
It really paints a picture of this deep relationship, doesn't it? It's not just handing over a check.
Not at all. The article stresses this: the best relationships are built on trust, communication, a shared vision. It's a partnership.
So VCs aren't just passive investors, they're active players.
Very much so. They bring their strategic insight, their industry knowledge, their connections. The entrepreneur leverages all that to grab opportunities and navigate the rough patches.
It really sounds symbiotic. The founder has the idea and the execution drive.
And the VC brings the resources and experience to boost that potential.
A good summary. And the source mentions aligning objectives being key.
Crucial. Everyone needs to be on the same page about the goals, the pace of growth, market strategy, the ultimate destination for the company.
To avoid clashes down the line.
Exactly. Misunderstandings about expectations can really derail things. Clear communication and agreement on the big picture are vital.
The article even mentions governance. So VCs often take board seats, right? Helping with oversight.
Yes, that's common.
Yeah.
And ideally within a good relationship, that oversight is constructive, helping keep the company on track towards its goals.
Okay, so let's step back. For us on the outside looking in, how do VCs actually choose who to back? It must be tough. What do they look for?
It's a really rigorous process.
Mhm.
And one of the absolute biggest factors is the team, the founders.
More than the idea itself?
Often, yes. They look for a compelling vision, sure, but also deep industry knowledge, proof they can execute, resilience, leadership. Can this team actually build this business and handle the bumps?
So a great idea with a shaky team is a no-go.
Generally, yeah, high risk. Then they scrutinize the business model. How will it make money? Can it scale up efficiently? Is there a real, sustainable, competitive advantage?
They need to see a clear path to making money and grabbing market share.
A big market share, potentially. That scalability point keeps coming up. They need to see how this can become much, much bigger without costs spiraling proportionally.
And scalability ties into the market itself, I suppose.
Directly. VCs usually want markets that are already large or growing really fast. There has to be enough room for the company to become significant and deliver those big returns they need.
Makes sense. And the actual product or service?
Well, yeah, that's core too. Is it unique? Does it solve a real problem for customers? Is it genuinely better than what's already out there? Can it attract and keep users?
So a whole checklist of things to evaluate.
Absolutely. Team, model, market, product, they all have to line up.
Now, it sounds great when it works, but the article is realistic. It talks about limitations too, on both sides. What are the main hurdles for entrepreneurs?
Well, the harsh reality is the high risk of failure. Most startups just don't make it, even with funding.
Why is that?
All sorts of reasons. Maybe the market wasn't really there, or they ran out of cash, or got crushed by competitors. It's tough.
And getting funding in the first place is hard, as the article notes. Financial constraints are a big one.
Huge.
Huh.
Especially early on, or if you don't have the right network. Securing enough money is a constant battle for many. And even if you get going, just managing everything.
Product marketing, sales, hiring.
Exactly. It's incredibly demanding. The article mentions burnout, which is very real for founders.
Okay, what about the limitations on the VC side? It's not a perfect system either, right?
No system is. One key thing is the pressure VCs are under themselves. They need to deliver high returns to their investors, usually within a set time frame, like 5–10 years.
Ah, so that creates pressure for fast growth and big profits from the startups they back.
It certainly can. Sometimes that might mean pushing for short-term gains or rapid scaling, perhaps at the expense of, say, long-term sustainability, or maybe even a more cautious, innovative path.
So the focus on speed could potentially compromise the original vision sometimes.
It's a potential tension, yes. And we touched on access earlier. Getting VC funding is competitive. It can be really hard if you don't have a track record or connections. It can feel a bit like an exclusive club sometimes.
You need the network to get into the network.
Something like that. Yeah. And finally, the control aspect. VCs invest a lot, so they often want significant equity and a fair amount of say in decisions.
Meaning the founder might lose some autonomy.
Potentially, yes. They might have less control over the company's direction than they initially envisioned. For founders very attached to their original idea, that can be a tough pill to swallow.
Okay, so wrapping this up, our look at this cognitive market research piece really highlights this essential connection. Entrepreneurial vision needs that VC fuel the money, yes, but also the guidance, the network. It's key for growth, for innovation.
It truly is a powerful synergy when it works well. But as we've discussed, it's vital to remember the challenges too. The high risks for entrepreneurs, the pressures and potential downsides of the VC model.
Right. So here's something for you, our listener, to chew on. Given these limitations, the startup failure rates, the VC pressures, what new ways to fund innovation might pop up? Are there other models emerging to tackle these challenges?
Or, thinking back to that recent dip in investment we started with,
Hmm.
how do entrepreneurs and VCs need to adapt their own strategies to keep things moving forward in this potentially tighter landscape? What new approaches will they need?
Lots to think about there. It's a dynamic space, constantly shifting.
Indeed. And understanding these core relationships between ideas, money, and expertise is just so fundamental if you're interested in where business and tech are heading.